Thank you so much, Mr. Rob Cavic, for joining us. You may know Rob from a lot of the amazing data he puts out. He is the senior economist and director of economics at BMO. So, Rob, thank you so much for joining us today. Dan and I have referenced your research and insights multiple times over the last few years. So, it's an honor and a pleasure to have you here with us today.
Yeah, thanks for having me, guys. Happy to do it.
Great. Why don't we start off really quickly? We've got some really great questions for you here. Bank of Canada rate cuts, opportunities in the market, challenges, all that kind of stuff. Before we get into the nuts and bolts, give us a little background on who you are and maybe why we should be asking you some of these kind of harder questions.
Well, so as you mentioned, senior economist, Bank of Montreal. So I spend most of my days just covering the Canadian economy, Bank of Canada policy, and I spend a lot of time on housing and Canadian real estate. That's kind of one of the areas I specialize in within the team. And I've been doing it for a while. Like I've been, going. How long has it been now? Going back probably, well, at least the last decade. We've been very, very bullish on Canadian housing through, a lot of those times when we had a lot of people calling it a bubble and we had a lot of US investors looking to short Canada because of our
Yeah.
quote unquote housing bubble. And it was not, it was nothing, anything like that. And, so we were really bullish over that period, which maybe gave us some credibility. And then we also kind of came out in early 2021 and said, look, things are going off the rails. Bank of Canada needs to tighten policy and stop this. And unfortunately, they were about a year or so too late, and we kind of saw what happened with a lot of the froth build up in the market, and we're kind of dealing with the consequence of that now. So, um, that's my background, and some of the views we've had going back over time, and that's where we are today.
Amazing. So we are going to start to tap into that crystal ball that you and your team over there may have. I'm kidding, obviously, but you guys put in so much work and look at so much of the data that I think one of the reasons we wanted to have you on, especially right now, was we had recently looked at your analysis of the Canadian housing market and past corrections. So I know Dan, you have a question on that. Why don't we use that to kind of kickstart the conversation here?
Sure, yeah. So you made this chart that I wish I made, but it basically has it's one of my favorite charts I've ever seen. It has all of the housing corrections mapped on top of one another, and it looks like kind of we're pretty close to the worst scenario that we've seen, other than I think Vancouver's 1990s. So I was born in 1991. Nick was a little older. I think he was 4 or 5 in the 90s. So he was probably participating in the real estate market and a little bit more aware,
Yes,
but I
big
but I
time.
wasn't. So can you tell me kind of like how we compare to that scenario based on your analysis, and what Canadians should be expecting based on, comparison to past housing corrections that we've seen?
Yeah, sure. So I was participating in real estate in 1993 or so, but I was a young teenager. My father was a home builder, so I was dragging
Oh,
bricks and
awesome.
crap around his construction site when I was a kid, getting paid with a can of Coke, but that's another story. Um, so the comparison is that, so like peak to trough, like this is a very textbook housing recession so far, right? So peak to trough, we've seen Canadian home prices fall like 15, 16%. We've kind of come off the floor a little bit. Toronto, Southern Ontario has been a little bit worse, about like 18, 20% peak to trough, and we haven't really come off the floor. So the first thing I would say is we tend to look at the Canadian numbers because that's what everyone quotes and that's what gets published. But Canada is, as you guys know very well, not really a real estate market, right? It's a collection of local real estate markets. So if you were to look at that chart in somewhere like Calgary or like a Moncton or Halifax, it would look a lot different because those markets hardly budged during the downturn and they're pushing record highs right now.
Mm.
Vancouver would look a lot different too. The correction was pretty mild, and we're maybe like 5 or 6% off the highs at this point. Uh, so this is really a Southern Ontario story, and in that sense, we are tracking, as you mentioned, some of the uh, tougher real estate corrections that we've seen historically, going back to like the early 1980s. And so the benchmarks would be that correction we saw in Vancouver through the mid 90s, yes, but also that 1990s downturn and really long bear market that we saw play out in Ontario. And so we're not of the view that this environment is going to turn out to be that bad, because a lot of things went bad during the 1990s that we hope don't repeat this time around. But at the same time, you got to kind of be mindful that a lot of things rhyme with the 1990s too, right? And I would, just to point out a couple things. One is, if you look at things like housing valuations and how stretched they were in 2021, very comparable to what we saw around 1990. If you look at what was driving the market through 1990, it was a lot of speculative activity, investor demand, and a big increase in immigration that then got turned off. Well, what are we looking at now? We saw a lot of speculative activity in the market, big increase in immigration that's now getting turned off. The other thing I would say is, if you step back and look at like longer term demographics, in about 1990, the baby boom was peaking at right around 35 years old. Right now, the millennials peaking right around 35 years old. So there are a couple overlays that kind of suggest that, look, this decade plus long run that we've seen in housing has kind of maxed itself out, and we're going through a period now where we're just going to kind of grind sideways for a long time. And I kind of say that's less bearish in the 1990s, because as you work through the 1990s, a lot of bad stuff happened. Like we had a fiscal crisis, we had a currency problem. The Bank of Canada had to raise rates when they didn't want to, and that kind of made that situation a lot worse. And hopefully we don't go back there, but who knows?
Yeah, do you see that
it all
being a
sounds
potential
eerily
outcome?
familiar.
Oh, yeah. Sorry, Nick. I was just going to say, like, given the Bank of Canada's monetary policy report that came out today, and their recent analysis on the impact of tariffs on potentially like creating an inflationary scenario, do you see that being a potential, like, the setup that you described in the 90s? Is that something that we could see happen, where we are dealing with a bit of a currency crisis, or maybe rates having to, not be as effective as of a tool as the Bank of Canada might want them to be?
That would be a concern for sure. So the backup in real interest rates through the mid 90s was pretty significant, right, at a time when the bank wanted to be cutting rates. So I don't think we're going that far. But like, look at the Bank of Canada today. They're talking about this 25% tariff threat, and they're kind of sketching out the economic impact and the policy response of that. And they themselves won't come out and say that we're going to cut rates in that environment, even if we're looking at recession-like growth, because they're not sure how big the impact on inflation is going to be, right? From a textbook perspective, we know if we retaliate with 25% tariffs, it's going to be inflationary to some extent, but they don't really know whether it's going to be such an extent that's going to prevent them from actually cutting rates.
And I guess
I would say at minimum, maybe like it keeps them from cutting rates as much as they want. But again, it's like, it's something they have to be very careful with.
Is that because, I guess, like, if it is inflationary, it would result in a little bit of demand destruction? So like people would buy less, and then you don't know if it actually ends up being inflationary or perhaps disinflationary?
Well, so they know there's going to be a negative growth impact, and they know there's going to be a positive inflation impact, right? So if we're a small open economy, we put a 25% tariff on U.S. imports of consumer goods and manufacturing equipment, stuff like that. That's going to pass through to the consumer. We just don't know exactly how much, and probably more importantly, like, we don't know what impact is going to be worse: the growth impact, which will be negative and cause them to cut rates, or the inflation impact, which will be positive and kind of prevent them from cutting rates. I personally think that if this was actually going to happen, we would get a more significant growth impact, and the bank would probably be cutting rates through 2025, even though they don't want to explicitly say it because they have to defend that inflation target. But I think that's the way it would go.
Yeah.
Right.
Yeah, it's really interesting. So let's pause there and maybe talk about what just happened, right? We literally just saw this morning, we're recording on Wednesday, January 29th, the Bank of Canada made, I believe, its sixth consecutive rate cut after the period of extreme rising in rates for quite a while, and then a little bit of a period of a break, and now we're seen to be on the other side of that roller coaster. Rob, how do you expect this to change things in relation to the economy in general, residential investment, the end user real estate market, and overall sentiment, which I think is obviously extremely important for the the average Canadian, when they see the rates coming down, they probably immediately think relief. But what is the actual effect or the actual impact of a rate cut now after all these other cuts?
Yeah, so those are good questions. I don't think the impact is all that much, to be honest. And I remember when this easing cycle started, and there were a lot of people jumping up and down saying this is going to set off the real estate market again. And we kind of said, hang on, I don't think that's going to be the
Yeah.
case for a couple reasons. Because number one, like the valuations and affordability are still so stretched that these early rate cuts aren't going to really change the calculus much. But more importantly is that the market had already priced all of this in, right? So we saw variable rates cut 25 beeps today, but for the last year or so, the market through 3 and 5 year fixed mortgage rates has already priced all of that in.
Yeah.
Right. So if you look at what I tend to do is look at what's the lowest available mortgage rate out there. It's, you guys correct me if I'm wrong, but let's say like 4.3 or 4.5% for 5 year fixed, somewhere in that range.
Yep.
That didn't change today.
Mm-hmm.
And if we're coming off variable that was around 4.75, well, the lowest available mortgage rate today is still around 4.5%. So I don't think it changes too much. What I've kind of been arguing is when I go through the arithmetic on just the affordability of a household walking into a bank and trying to qualify for a house to live in, or for an investor from a cash flow perspective. And again, you guys probably have more insight on this than me, but when I look at like cash flow dynamics in a market like Toronto, 4.5% borrowing costs don't work. When you get below 4%, maybe down towards 3.5%, things start to get, I don't want to say like extremely positive, but they're not ridiculous anymore.
Yeah.
And we're not there yet, unfortunately. So I don't think this does a whole lot. It's still a pretty stable market.
Yeah, it's funny, Rob. We recently titled an episode "Are We There Yet?" because I think that just seems to be the general, when is this going to make a difference? Now, you mentioned the Toronto market, you mentioned, investors and cash flow, which I want to kind of ask your opinion on as well, right? We're seeing rents in a lot of major markets across the country actually decrease for the first time in quite a few years. What's the correlation between what we're seeing in the market from a buy, sell, interest rate, inflation standpoint, and the correlation between these rents falling from your perspective?
So the rent story is fascinating. And again, when we're talking about this, we tend to focus on Toronto and Southern Ontario because that's where this market dynamic is most dramatic. There are mentioned at the start, there are markets out there, like Alberta, Atlantic Canada, for example, where none of this really applies, right?
Yeah.
Prices are rising and cash flow dynamics are better. So assume we're talking about, let's say, the GTA, Southern Ontario right now. I think two things are happening right now on the rental front. One is we've argued all along that the vast majority of the problem on this front was because of excess demand, not necessarily a lack of supply. It was 3% population growth, 1.5 million people coming into the country on a yearly basis, 800,000 non-permanent residents. First thing you need is a place to live, right? And you guys know in real estate, supply takes years and years to get online. Demand can change in minutes. And so with the stroke of a pen, policymakers looked at the immigration situation and said, well, this isn't really appropriate. And with a stroke of a pen, they choked off those immigration flows. And so I think the bearish view that I have on rent for 2025 is because we're going to go from 3% population growth basically to about zero.
Wow.
At the same time that we're seeing record completions come to the market, either through purpose-built rental channels or a lot of investors that maybe locked into a project in 2020, 2021 that's coming to completion and that was intended to be flipped. Well, you can't flip it without a big capital loss, so you're going to put it on the rental market. That's going to add supply right at the time when rental demand is backing off. So I think rents are going lower still, yeah.
Yeah, I'm of the same perspective, and I actually I got lucky. I called this shot like pretty early when I saw rents rolling over in Q2, and I actually Q1 in student markets, and then Q2, and I kind of forecasted that the government would whether I'm right or wrong on this one, but I thought, they're going to try and take credit for it with a policy because they have the data ahead of time. And they did in both cases with the student rental cap and then the non-permanent residents. But I think that and that kind of, the Bank of Canada put that chart out in their January monetary report last year where they showed rent inflation alongside population growth. And the correlation was pretty shocking. I guess then, from, our audience is mostly investors or people interested in buying real estate. And so I'm going to ask you the question that everybody hates to answer, but I've never heard anybody answer it as well as you did when we first spoke doing an interview for Better Dwelling, which is, when do we get there? What are the signs that this is a market that's worth entering? Because I would assume that continued falling rents will materialize in prices continuing to fall based on, if yields stay the same or if cap rates stay the same and rents fall, then valuations should go down with rents. If I'm an investor and I'm trying to time the market, which we all know is a fool's errand, but if I am, and the market's going to go sideways for a little bit, what am I looking for? And what does the market show me over the next couple of years?
So there's a lot to unpack here. So I would say
asking questions with way too many questions.
No, that's cool. That's cool. So if you're if you're a young family actually legitimately looking for a house to raise your family, the water's probably pretty safe now, right? Especially for a single attached house. All right, we're down 15% off the high, and we might go sideways for a couple of years, but that's probably safe in most parts of the country. I wouldn't buy a one-bedroom condo in Toronto, but the rest of the market is probably pretty safe. You're asking about investors though, and I think we're not quite there yet. And the couple things I would be looking at would be everything is a trade-off, right? So if you're looking at a property right now with, let's say, like a 4.5% cap rate, so we've probably backed up a full percentage point or so. But when borrowing costs are 4.5%, when you can go out and buy 10-year risk-free GOCs for like 3.5%, that you're not being compensated enough for that risk to take on an asset that's very illiquid and has tenant payment risk and a lot of landlord tenant board issues and all that kind of crap. You're not getting compensated enough. So something has to change. Either long-term interest rates and borrowing costs have to come down further. And we're of the view that we're pretty much around neutral right now for interest rates and borrowing costs, right? So 3% Bank of Canada would be neutral. 3.5, 3.75 for the 10-year would be about neutral. So if that's about what's normal, then cap rates have to change. Okay, so cap rates can change, rents can continue to rise. Well, we talked about that. Rents aren't rising, they're falling. So how do you get cap rates up to a level that compensates you for the amount of risk you're taking to buy real estate? Well, prices have to come down some more. And again, I'll defer to you guys because you're literally out there in the market as we speak, but it seems like the investor is just absent because the cash flow dynamics don't make sense yet. They're not being compensated enough for the risk. And probably most importantly, you could look past some of that if prices were rising 20% per year, right? Like, okay, who cares what happens with rent? I'll just flip the place next year for 20% more. Well, that's not happening anymore either. So yeah. That side of the market is just not there yet.
Yeah, as you said, Rob, I mean, I think what we're describing is really, it's a tale of two cities, or it's a tale of two cities, mainly probably just Vancouver and Toronto and surrounding areas versus the rest of the country. Because as you said, right, Dan and I are on our boots on the ground. We travel the country meeting investors, and it is, the sentiment in, a Red Deer, Alberta, or a Saskatoon or a Halifax is a hell of a lot different than someone who bought 3 pre-construction condos in downtown Toronto and is now trying to, flip them or get rid of them or assign them and deciding, making that unfortunate, tough decision. Do I want to lose money fast or slow? So, I mean, I guess just one more piece on that kind of multi-part question that Dan asked is, are we close to that bottom yet? Are we on the bottom? And if we've hit the bottom, we're trading sideways, I guess, because again, going back to timing the market versus time in the market, is it better for someone to get in now, or is there any reason to continue to wait on those proverbial sidelines we've heard so much about over the last little while?
Yeah, like I would say the bulk of the risk is past, right? You didn't want to get stuck in 2021. I would have been like completely hands off in
Yeah,
2021. But because we're already off, like again, it depends on the market. Because we're already off 10 to 20% and we're starting to stabilize a bit, I think it's like it's closer to that point. Um, there's there's no rush though. Like in a market like Toronto or most of Southern Ontario, to me, it doesn't look like there's really any rush. And again, it's like you mentioned, we always have to condition this. We get in this trap of talking about Toronto and the dynamics here. It's a lot different in a market like in Alberta or Atlantic Canada or even Vancouver.
for sure.
So I'm not directly answering your question. I
That's
think
okay. You're doing a very good
we're
job slightly
we're
avoiding it. I appreciate it.
no, we're probably very close to the low. The thing I'm concerned with is in a market like Southern Ontario, that low is probably going to be with us for a while, right? And
Mm,
if you're not able to absorb some negative cash flow or some risk without prices really accelerating higher again, that's probably not a good environment for you. If you're able to just pick up quality property and just sit here in a tough environment for even if it's a couple of years still, and not be stressed out about any kind of cash flow dynamics or anything like that, then yeah, you're probably closer to the bottom than certainly closer to the bottom than the top.
Yeah. Um, I think that, you know, I guess you kind of get to the long term recovery scenario really ends up being based on like just affordability and income, right? If people can afford to buy houses, and incomes are growing, and then the prices could eventually recover, and investment properties, same thing, just as a function of rents, which is second order effect of the incomes of the tenants. In all of that, is there any risks? Tariffs probably a big one that stands out to me, but is there any risks that really stand out to you that remain in the market that people should be thinking about?